One of the most basic concepts in trading is to trade with the trend. Does it apply in day trading? That's what we'll look at in this episode of Day Trading Basics. All right, day trading with the trend. What does that mean? For most people would say that, well, you want to trade a stock that is going up on the long side and a stock that is going down on the short side. But there's another element to that, and that is the overall trend of the market. You would think it maybe wouldn't matter a lot, but it actually matters a whole lot. To be primarily focused on buying stocks on days when the market is going up and primarily focused on short selling stocks when the market is going down is actually very important, and I've got the data to back it up, and that's what we'll go through in this video. Many day traders, really they're hyper-focused on the individual stocks that they trade. They fail to see the impact of the movement on those stocks in the overall market. And so while very abnormal stocks will typically disconnect from their correlation to the market index, that separation is not complete. It is important to analyze the overall market direction as well as the direction of the individual stock. Now, I like to do data-based analysis, and to demonstrate the concept of trading with the trend, I will show you how the performance of a basket of stocks is affected by the overall market direction. And these are a basket of stocks that meet the criteria of my day trading strategy. Now, that day trading strategy is really focused on finding the stocks that are leading the market, either up or down, but we're going to see how strongly correlated the performance of those trades is with the overall market. Now, as I say, good analysis is based on data, so that's what we're going to use. It's not based on pulling out a couple of trades here or there. We're actually going to use data based on many trades so that we can get an accurate representation of what works most of the time. So before we get into the data, I need to explain to you how it's generated and what everything means. So I measure my performance on a trade in terms of reward for risk, and I'll show this on the chart in a moment. What it essentially means is that if I risk $100 and make $100, I have earned a reward for risk of 1. If I risk $100 and make $400, then I have made a reward for risk of 4. You get the idea. At the same time, if I risk $100 and lose $200, then I've actually incurred a negative reward for risk of -2. So I'm an algorithmic trader, and that means all of my entry signals are based on logic-based rules. There's no gut feel, no human judgment. It's just, do the stocks meet the rules? Yes, then the trade is taken. And what I have been doing over the last, over a year now is accumulating every valid trade from my algorithm for, every single stock that comes up through the trading day. And in a typical trading day, we might get anywhere from 20 to 200 valid entry signals, and I accumulate all of them in a database. Now, I've computerized my analysis completely so that every valid trade's performance can be measured. There's no human bias in this analysis. It's, if the trade is met, then we can track the performance and we can put that into a database so that we can see trends in how that strategy works over time. So there's some key data points that we need to understand. First is the reward for risk of each valid trade, and then also the combined reward for risk for all of the valid trades by the hour, by the day, by the week, that sort of thing. From that, we can plot a reward for risk curve, and I'm going to show you some reward for risk curves from Friday's trading based on my strategy as signals were generated at different times of the day, and we'll compare that to the market index chart to see how that reward for risk curve moves with the movement of the overall market index. All right, so before we go any farther, let's just understand what reward for risk is and where valid entry signals are and that sort of thing. So this is a 2-minute chart of a stock that generated a buy signal right there. You can see there's a little pink dot there. That's my algorithm indicating that that stock met the requirements of that strategy. This was the previous day over here, and then this is the current day, and you can see that this stock went from roughly $1.30 or so, and it went up, and then it came back and moved around a fair bit through the trading day. All right, so each one of those horizontal lines, those green lines, represents one reward for risk. So we have, you can see there, it says 1.0 RR, 2.0 RR, 3.0 RR. So at 3.0 RR, that is a reward for risk of 3. So if you risked $100 at that $1.69 level, you are earning $300 of profit. All right, so we track all of those things in a spreadsheet. And we can also use it for short sales because, of course, sometimes we want to make money from stocks going down. So here again is the entry signal. Now it's a kind of a gray dot rather than a pink dot. And the reward for risk lines are here. And as the stock falls, it's earning, 4, 5, 6 RR. And it ended up, in this particular case, closing at about 6.2 RR, which is right about there. All right, so then we take all of that data and we put it into a spreadsheet. And this spreadsheet, you can see, this is the long side. It has almost 60,000 lines of data. And this goes back to February of 2018. So in just over a year, there has been 59,000 stocks that have triggered an action candle. Now, not all of those are valid trades. We have some other rules. It's not just the action candle. There's some other things that have to be satisfied, but still, there are thousands of valid trades in this spreadsheet. And because we have so much data, we can start to gauge whether the strategy works or not. And this strategy is pretty consistently profitable week after week after week, and the data is there to support that. Now, I can also summarize that last page, which was the individual trades. I can summarize it by day. And so you can see the 22nd of March on the long side, it was a losing day, minus 23. And on the short side, it was a profitable day of almost 66 RR. Now that's 66 reward for risk on 28 trades for an average of 2.35 RR per trade. And then we can extrapolate some other values here based on different risk reward levels and also slippage, which we always need to factor in. Now we can then go to the next page and look at the actual reward for risk cumulative chart for the long and short. So this particular line here is all of the shorts that came on Friday, March 22nd between the hours of 9:30 and 10. And this is adding up the reward for risk of each. So if we go back to this page, you can see right here that the total reward for risk of the shorts was 65.92. There it says short, and there was 28 trades for an average of 2.35 per trade. If we go over here, we can see that the closing value right there was about 65.92. All right. However, it didn't, wasn't there all day long. That's where it closed at the end of the day. We can see the journey that it took to get there. Of course, at the open of trading, 9:32, we're at 0. And as the market was falling and as these stocks were falling, of course, their profitability was rising. And it maxed out at 70 RR at about noon, so 11:58. And then it pulled back a bit and went back up to around 70 at about 1:45. And then it fell off for a while, went all the way down to less than 30 RR in total. And then it rallied into the end of the day as the market sold off. Of course, this is short, so you're making money from the market going down. And we finished the day at 65 and change. All right? So that's how that line works. But let's also take a look at the long side. What about stocks that were bought in the opening half an hour? And so again, if we jump back to the spreadsheet data, you can see that there were 9 valid trades in the opening half an hour. And you can see the time up here. So I can change the time. I could say 9:30 till 12, 11 till 2, whatever I want. I've got this set from 9:30 till 10 because most of my best entry signals come in the first half an hour. And so that's what we're going to look at for this bit of data analysis. So anyway, we had a minus 23 at the end of the day on 9 trades. And if we go back to that line, you can see that there were stocks that being bought, and cumulatively, those 9 trades together had their total RR move like this through the day. And you can see it finished way down here at minus 23 RR. So obviously then, looking at these lines, it makes some sense that we'd want to figure out why you would want to be short selling on this day rather than buying, because the shorts worked really well and the buys did not work really well. And that's where that trading with the trend of the market comes in. Super important to understand this. We're not going to always go long and short. Some days we're going to choose to go long, some days we're going to choose to go short, and we might even switch during the day. We might be short at the open for a few hours, staying short, and then go long later in the day because the trend changes. And that's the purpose of this video, is to demonstrate how the market moves, or how the reward for risk moves with the market trend. So this now is a chart of the S&P 500 on March 22nd. It's the S&P 500 ETF, SPY. And of course, you would think that since the shorts did well, it would be a day when the market was moving lower. And that's exactly what happened. Now, this is a 2-minute chart. So this is the open of trading on Friday, March 22nd. And you can see that the market moved lower until 1:45. Now, remember what I said about the max RR was at about 1:45? And then we had another strong RR value at about 12 o'clock. Well, those were the two low points on this chart. And then we moved up like this for a couple of hours, probably more than 2 hours. We moved up, and then into the close, we moved down again. Well, let's now just keep this image in mind. We're going to go back to the chart of the S&P, or of the reward for risk curve. So remember here, this is the reward, or this is the S&P 500 chart, how it moved minute by minute for the whole day. So we went down for a while, and then we went up for a couple hours, and then the final hour we went down. So let's now go back to that curve and look how it looks. It went up when the market was going down. Why? Because we're shorting, right? So shorts will make money when the market's going down. So it went up, and then at about 1:45 it topped out, and it went down for a couple of hours. Look at that, 3 o'clock right there, pretty much the low point. And then it went up again into the close. That was when the market was going down. The S&P chart basically looked like this. It went like this, and then it went up for a while, and then it went down again. And that's why we have this perfectly inversely correlated relationship with the reward for risk curve, because of course we were shorting this day. Now let's look at stocks that were entered later in the day. So this is the reward for risk of longs. So you can see here longs, and by long I mean buys. Okay, so these are buys from 12 until 3 on Friday, March 22nd. And look at how they really did well from 2 o'clock until about 5 to, sorry, big noise there coming from my other computer. From 2 o'clock until 5 to 3, they really did nicely. They actually had accumulated about 50 RR of value. Well, we would expect then, if that was what happened for stocks that were bought between 12 and 3, we would expect that the market moved up between 2 o'clock and 3 o'clock. Well, let's go take a look. Let's go back to that market chart. And between 2 o'clock, which is right here, and 3 o'clock, which is right here, look at what the market did. So this is driving home the point that the trend is your friend, and you want to trade with the trend. Even though we're trading individual stocks, they get like a turbo boost from what the overall market is doing. Let's take a look at the shorts that were entered between 10 and 12. So between 10 and 12, the total profitability of all those shorts did quite nicely until about 1 o'clock. And then at 1 o'clock, it just plummeted. Well, what happened at 1 o'clock? That's when the market started to go up, which means the shorts were going to have a tough time. They're going upstream. There you see 1 o'clock, the market moved up, and those shorts that were entered between 10 and 12, which were benefiting when the market was going down, now all of a sudden they started losing value, losing profitability. All right, so the point of all this is that the overall market direction matters. Now, I will tell you that the more abnormal a stock's volume, the less it will be correlated to the overall market. So if you have a stock that's trading 10 times what it would normally trade in terms of volume, it's going to not be so correlated to the overall market. Most stocks are always have some correlation to the market, but the more abnormal ones, they're moving on their own story. It doesn't matter so much whether the market is going up or down. By the same token, however, The more abnormal the overall market, the more it will affect individual stocks. Now, some of you may know that on Friday, March 22nd, we had a pretty strong sell-off in the overall market, and that meant that it dragged a lot of stocks down with it, which is why it was a great day to be short, because we had an abnormal move to the downside for the overall market, and it meant that if you short sold a lot of different stocks, most of them made money because they got dragged down with the overall market weakness. So what the key point to take away then is you want to start your analysis with the analysis of the overall market. Try to predict, is the market going to go up in the short term, or is it going to go down in the short term? And if it's going to go up, favor buying, and if it is going to go down, favor short selling. All right, so there's some more things that you should take a look at. I'm going to put a link in the description to my action candle video for those of you that want to understand my actual strategy and why there's those pink dots on the chart. Take a look at that video. Again, I'll put a link in the description. Also, I've got upcoming events on Stockscores.com, so I do webinars and some live events. Go to the upcoming events area of the Stockscores.com website and you can register for any of those events. They're free. Leave your questions in the comments below. And of course, as always, hit that subscribe button if you enjoyed the content, and why not click on the like button. That'll let me know that I should do more of these videos. Most importantly, trade well.